Sarah Marinan here, and if you've watched other videos of mine, you've seen Mike Spindler with me before. And there's a really important topic that I haven't been seeing many people address, particularly real estate agents and lenders. And so Mike and I are going to talk about forbearance. What is it? Who's using it? Why it's there? What are the consequences, if any? What do you need to do to come out of that? We're just going to start from the beginning and talk about it. So, Mike, let's tell them what forbearance was and how that came about and became a word even in our everyday lingo now.
Yes, yes. So mortgage forbearance, part of the CARES Act, when the pandemic first started over a year ago and shutdowns were coming, the government knew that there were some financial hardships that could come along with that due to loss of income. So for homeowners, they created the mortgage forbearance program, which is the mortgage payments on your current monthly mortgage they're not forgiven, but they're kind of put on pause. And with the agreements, you had to show what is your hardship, why do you qualify for forbearance, which were pretty loose guidelines because at that point they didn't have a ton of information on what was going to happen. So a number of people who maybe didn't have a job loss also put their mortgage into forbearance, meaning a pause on your monthly payments. Particulars with that program, putting the pause on your monthly payment does not impact your credit. So it's not looked at as a late monthly payment on your mortgage, which is good because that can destroy your credit when you have mortgage late payments.
But also, unlike foreclosure that happens from missing payments, it doesn't allow you to go into foreclosure for those missing payments either.
Correct. Yes. So it was a nice protection for homeowners who were experiencing difficulty through the pandemic. That has been extended a couple of times, and now it's extended through June of 2021. And we don't know what's going to happen after that, if it will be extended again, but the powers that be will have those discussions, and we'll hear about it probably the last couple of days right before the deadline. However, what does this mean when you're in mortgage forbearance and you want to either refinance your mortgage or sell your home and purchase a new home? With forbearance, so those monthly payments are not just waived or forgiven, they're just put on pause. So when you get to the point where you're not experiencing the financial hardship anymore and you want to unpause your mortgage payments, you have to work through your mortgage servicer to do that and set up a plan. There are several different plans. I don't have all the information on all the plans and the repayments for that, but that money, those paused mortgage payments, do have to be paid back, either one in a lump sum when you take your mortgage out of the Forbearance Act, the CARES Act forbearance.
Which, if you haven't been saving, that's going to be really rough.
Yep.
3, 4, 5, 10, however many months you've been in forbearance, all back. And I can't expect that a bank would assume people have that much in savings or they wouldn't have gone into forbearance. So it's more like they're going to work with them, like either through higher monthly payments for a while until they're caught up or tacked on to the end, right?
You got it. You got it. So no mortgage servicer is going to require you need to have that lump sum when you take your loan out of forbearance. So that's the good news. But different things that I've seen is potentially, and it's up to the servicer, when you provide your scenario and what's happened, they'll either add increased monthly payments until that is paid back, amortized over a certain number of years, whatever you work out with them. They add it to the end of the loan potentially. A lot of different options, and you have to work through the mortgage servicer when you want to take that loan out of forbearance. You can't just start making your monthly payments again. So that plan, they need to be notified that you're doing that and what that go forward plan is going to be for your individual situation.
So now, then let's say they want to refinance. Like you said, they're like, okay, we're back to work. We're making our income again. We've heard that rates are killer low. We're going to come out of forbearance and refinance.
Yes. And this is something that we're running into a lot right now and have for the last couple of months is if your loan is currently in forbearance, you're not eligible to refinance your mortgage until a couple of things. One, if you worked with the servicing company and take your mortgage out of forbearance, you can pay all those payments up front as a lump sum. We got to document the funds to see where that's come from, to make sure there wasn't a loan taken out to make those payments. And you have to demonstrate to the mortgage company that your hardship is done with, and you've saved up that money, you've made that lump sum payment. Then you're able to, at that point, once it posts, we get the verification and the satisfaction of the mortgage payments, and then you're able to refinance or purchase a home. That's not the most likely outcome that we're going to see, because some of those payments, like you had said, Sarah, have been put on pause for several months, not just a couple of months. So that can be a substantial amount of money. So the next requirement then, if you don't make the lump sum payment, is you are required to pay 3 monthly payments consecutively that we track through your credit, through a verification of mortgage payments with your current mortgage servicer, to show those 3 monthly payments have posted. Once that third payment's posted, then you are eligible to be approved for a refinance or a purchase of a home. Now, the one thing to note that is a common misconception is there's confusion around those 3 monthly payments, and just can I just make those 3 monthly payments up front, or can I refinance, take cash out of the equity to pay that off? The answer is no. You can't do either of those, because if you have, let's say, 7 months of payments that were put on pause, you're not coming with that full amount. So you're not satisfying all the payments that were put on pause. So that's why we need to see the history of 3 monthly payments. And the reasoning behind that is it's proving that you're out of the hardship. You're able to make your mortgage payment again once you've taken it out of forbearance, and consecutively stability, making your payment for 3 months in a row. So that's one of the things we've done. A lot of refinances, and people have asked, customers have asked, can't I just include those at closing coming out of my equity in my home? And the answer is unfortunately no, because there's no history or no demonstration that the hardship is over by making 3 consecutive monthly payments. And that's not a rule that the lenders have come up with. This is the mortgage investors, Fannie Mae, Freddie Mac, HUD for FHA. So we have to underwrite and abide by the guidelines that they set forth to us. So we have loans that are saleable or investable from the mortgage investors.
Right. Well, they're just trying to make sure that people aren't just snowballing and rolling their debt one into the next, one into the next. And I had posted on my personal page on Facebook, because I'm even, and I don't know how I'm getting on these lists, but I'm seeing email after email saying, take the equity you've earned and refinance your house. And just the marketing emails are obnoxious. And first of all, I was looking at that going, most people haven't earned that equity such that they've paid down their house. It's just been handed to them by the market. And if at any point the market shifts, that equity could just be gone. And if you take it out and then the market shifts, you're underwater, and then you can't move, you can't sell. So unless you've done something good with that money, like refinanced or like remodeled your house, like fixed the furnace and done things to create longevity or improve the home so that the value goes up, then that's not a good use of that money. Now, it's okay if they haven't been in forbearance, right? But they've been really tight. And so they're refinancing to maybe get better payments to stay on track. Great idea. If they are refinancing, I'm not a financial planner, right? I always tell people this, or an accountant, but I've also seen people refinance to maybe further their education or switch to a different trade, like because of the pandemic, right? So let's say they've been in the service industry and they want to go to trade school because we are short on plumbers and electricians and people that we need. And they're going to take equity out to pay for their trade school for a couple of years. And then that's obviously going to give them a huge boost in being able to better pay their mortgage in the future. Okay, like that might be an okay borrow against that house, but it's for a long-term plan, right? It's not an immediate thing. because that's what happened in our last crash. People were seeing those messages and taking the money out and buying jet skis and, just not relevant to their best financial interest. I know the pandemic has been really bothering people and we all need a vacation, but that's really not what we should do with the equity in our homes.
We should not do that. And you are right. The biggest piece of advice I can give a client when they're looking at doing a cash out refinance is to invest into your property, like you said, because that's the best way to continue to increase that equity if you need to make repairs. Do not buy the boat or the jet skis, or debt consolidation is another reason to do it. But when you do debt consolidation to pay off higher interest debt, like credit cards, etc., do not charge those credit cards back up once you have them paid down, because that defeats the whole purpose, and then you're further underwater. You're not getting ahead. So make the smart decisions. Cash out refinances, there is definitely a place for them, and there's definitely great reasons for them, but be responsible about it so you don't get yourself in that financial trouble in the future.
I feel like this forbearance and refinancing is a really hot topic right now, because I have talked to a few people in the last couple weeks that still firmly believe we have some big bubble popping next year kind of thing. And they're not in the industry. And this is what they are sharing amongst their peers. And I said, why do you think this is a bubble and that we have to pop? And like, tell me your reasoning behind that. Well, it's just like last time. I'm like, but it's not just like last time. And let me explain why, right? And this time the government has actually a lot more control over what we see happen with housing. They have so much control compared to before with the forbearance and the rental moratorium stuff, and just what we're doing as far as handing out stimulus checks. They can pull back the reins on some of these things. We can have increased interest rates to slow down the demand, which will slow down prices. There's a lot of ways that there's no need for this bubble to pop.
Exactly. And like you, we have these conversations every single day, and we've been having them for the last 2 to 3 years as well. We've been hearing there's a bubble, prices are going to come down, and not from economists, not from the Mortgage Bankers Association.
It's hearsay.
It's hearsay, and I totally get it, because in the mortgage crash, the downturn back in 2006 to 2008, there were, like you said, Sarah, there's a lot more government regulation within the industry, and primarily on the risky mortgage products that were out there and allowed to be sold at that time. They do not exist anymore. A lot of the subprime products, the 100% financing to purchase a home, stated income, stated asset, negative amortization loans, which those loans you weren't even paying all the interest due, let alone zero principal on those programs. So those programs aren't out there anymore. So we're not going to get into the big foreclosure deal, because you can't make your mortgage payments anymore. There's a lot more regulation and a lot more making sure you as a buyer of a home are qualified to purchase that home. And then if you do get in some trouble with financial hardships, CARES Act, things like that come out to help with that, but it's not your free ticket to just not make your mortgage payment forever. Those payments need to be made, and that's what the consumers need to know. Then you brought up purchasing a home too, and we need to touch on that. For forbearance, it is the same. If you are selling your current home and you are on a forbearance plan, you need to, before you sell that home, reinstate the mortgage and make 3 monthly payments to be able to qualify for the new mortgage to purchase your new home. So
unless you plan to rent for a year, like I've seen that a lot too. People are just not sure where their next job is going to take them, or if they even want to stay in this state, a year from now or wherever. So I'm starting to see more of that, where people are like, hey, listen, I'm going to go shopping for a rental. Let's sell this house that I've been in forbearance on. As long as I can find a rental that's cheaper than what my mortgage payments have been, I don't have to catch up now then. You know what I mean? Like, they're just, feeling like, okay, let's push the reset button, and they're taking advantage of having all that equity right now, the high prices, and saying, listen, it's a nice market for a seller.
Yeah.
There's more videos on that. And if you're comfortable going to rent somewhere for a while, that might be a really good plan to just push the reset button, and then you can put that equity into savings or wherever else for a little while, to give you some security to go back to school. Same thing as when I talked about, if you're going to refi and take money out, it should be for something to better your future, right? And so it's the same thing with selling. That is a good alternative for a lot of people right now, especially if they have huge houses and maybe they're empty nesters, or they have been looking to get a bigger home, but they've been struggling with the payments on their current home. It's okay to take your family and just really step back for a little bit and rent a duplex for a little while or something.
Yeah.
Especially because who knows if you're working from home, or your location changed even by 50 miles, you can save gas money if you just go rent closer to work for a little bit.
Yeah.
There's so many good reasons to make a change in housing as an owner if you can right now. And yes, prices could be a little higher next year, but just with affordability factors, if anything, we're gonna be a little bit on a boggy up and down, and you would really have to probably time it to do any better than you would do this year in future years.
Yeah. Exactly.
A lot more about moving on the market's terms than right now. You can just move on your terms.
Exactly. And we don't know what the future holds, right? All of our economists are saying that home prices should, instead of being 9 to 15% increases year over year, as we see mortgage interest rates creep up and rise, and they've been at historical lows for the last year. So we are going to see interest rates rise, and projections are through this year 3.1%, where we're higher than that right now due to things that are happening in the market. But those projections still for next year are 3.5%, is what they're saying.
Still
we
awesome.
Could see it. Oh, they're unbelievable interest rates, unbelievable. Don't get the sticker shock because you're not seeing a 2 in front of them, because those interest rates they're untouchable, and it's probably never going to happen again. Or if it does, it may be years and years and years down the road. But
again, it was padded because of panic from the pandemic.
Those
weren't real rates.
Exactly. So if you took advantage of those, great. You're in a great spot for your mortgage, and that's the mortgage you're going to keep until you sell that house or pay it off. But as affordability decreases with interest rates going higher, we'll probably see home prices, instead of appreciating 9 to 15% a year. And Sarah, you know way more about this than I do, but we might see them like a normal appreciation rate, 2 to 4% a year. Which is still good. You're still making money. It's still a really good investment to do, but we won't see these crazy numbers go out there that the low interest rates caused the masses to go to the market and find that home to lock in that lower interest rate.
Well, and I have other blog posts and videos and things on that too, but 2 to 4% appreciation on a home, like you said, is pretty standard. We've been in a 10-year amazing run of dramatic double-digit increases in some years, and some areas haven't actually seen that though. Like there are plenty of townhome neighborhoods where they have not doubled from their bottom, and if you did the math on double-digit increases over 10 years, right, the prices should have doubled, and they haven't doubled. So just putting it in perspective that you're paying down a mortgage versus paying rent to somebody else, so you will have an asset at the end, is the idea of the appreciation of your house. But it's not all straight appreciation, right? Like you have to understand that a good budget to have is 1% of the value of the house as your annual maintenance cost.
Mhm.
Just money you should be tucking away to keep that house in good repair. I'm not talking about remodeling. I'm talking about fixing the furnace, fixing the roof. And so realistically, that's what then 1 to 3%
Mhm.
a year. So most of your equity comes from paying it down in a normal market. And I'm a little nervous that all of these good markets have given people false expectations for the future of the real estate markets.
Mhm.
And they just need to make really good decisions now about a place they can be in long term, or it's okay to rent.
Yeah.
I I I'm an agent. I'm supposed to say buy a house, build home equity. And I support, the Center for Home Ownership and all of these things, but it's just realistically not the same advice for everybody. And yeah, I would
That's right.
put that out there that we're not just here to tell you to get mortgages and buy houses. We're here to tell you it should be sound advice, not, we're not giving you financial advice, but sound advice on the purchase side, sound advice on the mortgage planning side, and knowing like what forbearance is, for example, and how it affects you, and really understanding that when you're making your plans. That's how you know you've chosen good lenders and agents to help you, that they really understand those circumstances and will give you good guidance in those, that then you can take back to your accountant or your financial planner or whoever else is helping you with your big picture financial plan.
Yep. Well thought out plan. Be responsible about it. Back to the cash out refinance piece of it. Be responsible in your decisions, making it so you don't get yourself into that trouble. And like you said, it's okay to do that reset. If you want to take advantage of the prices right now and sell your house and take a step back and figure out what your next plan is and rent for a year. I personally had a family member who did that. And it's completely okay. And it's smart to do that if you're unsure about your future and what you want to do. You got to be sure about that. And those types of decisions take time to think about and have to be planned. So
because there's always going to be costs in selling that house that you buy.
Mm-hmm.
So,
Mm-hmm.
If you don't have a 5-year plan for the house you're purchasing right now, or maybe 7 to 10-year plan, Mike, I know you want the business, but don't purchase the house.
Yeah, exactly. And it's funny, these are the conversations that Sarah and I have off camera, and it's the same thing. And that's why I kind of laugh. It's because we truly want the best for our clients, and we're in the business for our families and for the people that we help. So you tell, here's the service I got from these guys, and you got to talk to them. And even just if you want to talk it out, we answer questions for people all the time to help them. And we're not financial planners, but to help guide them through the decision-making process that they're looking at doing. It's not about, we're going to sell you a house and then move on. That's not the case. We want to help you, your family, and your friends too. And that's why we take the approach to the business, and we have for decades. I've been in the business for 2 decades now, and feels weird me saying that because I'm dating myself a little bit, but I'm 39. I started young. I was 19. So there, I have to say it.
We're not talking about my age because I've been told I look younger than I am, and I'm going to stick with that. So I think the biggest thing is just making sure that people aren't making hasty decisions because of what they're hearing in the media. That's really what we're trying to, I think, pummel home here. Don't just try to run after forbearance without knowing the consequences of doing it. Don't rush out and buy a house just because all your friends did and the interest rates are good. Be careful in who you are making your house purchase plans with. Are you talking to your best friend who just got their real estate license and needs your sale to pay their dues? Or are you talking to somebody who doesn't need your business and is still grateful for your business, obviously, but doesn't need your business, but wants to earn your trust and help you make a good decision, and not make decisions for you, because that is your place, right? They just need to provide you with the information like Mike and I are doing here too. You know, even if you want to buy another house after forbearance, well, here are your choices. Here are your options.
Yeah.
I'm not going to tell you what to do, but
Yeah.
yeah. Mike, anything else you want to add on forbearance, since we're kind of coming full circle back to that? We always get on these tangents, but it's because we're so ingrained in this every day.
I was just thinking to myself, we always have a plan that this video is going to be 5 minutes, 7 minutes, maybe 10 at the most. And I'm sure we've been recording for 25 minutes now. But if you have specific questions about this, reach out to Sarah. She'll get you connected with me, and we can talk through it and just answer the questions that you have regarding it, because there are going to be a lot more questions than what we covered at a high level today. And that's why we want to do this, to spark those questions for you so you can make that plan for your future.
Right. Or, you know, this is kind of a really nice way to help a friend or family member, even if it doesn't apply to you, by saying, hey, I saw this. I don't know if you, because you're in hospitality or restaurants or whatever industry may have been affected, if this applies to you, but, you know, here's my helpful hand without getting in your business. Share the video. And then that way, like you said, we can really just have a conversation with them, and it's always confidential. And if they call us off the video, their family member won't even know they did it. So
you got it.
But Mike, have a great day. I know that this is a time sensitive video, and we've had beautiful Easter and wonderful weather, and now a couple rain days, but that means that the market is hot.
Yes, it does.
If we don't call you back in 1 minute, we're sorry. That's why we have to record these things at 6 in the morning before everybody is blowing up our phones.
That's right.
But we're here for you even when we're busy.
Yeah.
Be patient with us, and we'll be helpful for you.
Thanks, everyone. Thanks, Sarah.
Have a great day.